Hello, ladies and gentlemen, and welcome back. Today we discuss stocks, commodities, and cryptos, but we need to focus in on two things. Interest rates, where are they going? It looks like higher for longer. And also AI, the craze continues, but now everybody's talking about it. With candles like this, you wouldn't be mistaken to believe a blow-off top is coming, but timing it is going to mean everything. Today, we look at some other opportunities within the AI sector that I think might interest you, and also we take a look at the data towards some sectors that are completely unloved. Well, welcome back everyone to the Daily Show, where we talk about everything to do with the macro, lead indicators, news, and of course the hottest charts. If it's your first time here, welcome to the community. Subscribe, smash that like button. I'm sure you're going to find a lot of value in today's video. We have a lot to cover. So articles are coming out. Everybody's trying to pick the next big thing in AI as everyone jumps on board the NVIDIA craze. Some stocks were up as much as 17%, riding the curtails of NVIDIA. And we know that at these points, it's usually a point where you need to say, whoa, pump the brakes and look for alternative assets. If you're in it, fantastic, keep riding it. But when the turn happens, and eventually it will, you'll have to be aware of it. And of course, this is all about now scaling out of your position and potentially recognizing when trends change. So the forward PE ratios, what's going on right now? If you've been watching the channel for a while, you'd know that I like looking at big caps, small caps, mid caps, all of these types of things and seeing whether they're cheap. Large caps are basically trading at 18.2 times forward PE. 16.8 and under is when I consider them a better zone. So is it a good zone? Not really right now. It's not shocking, but it's not great. What about mid caps and small caps though? They're trading at some pretty deep discounts. And of course, there are opportunities in those areas, which we'll talk about a little bit later. If you haven't already followed us over on Twitter, definitely do so. I shared two interesting articles today. One was what JP Morgan is expecting out of other technology stocks for the AI revolution and what they believe are going to be some stocks that benefit from it. I also shared here the change in target rate probabilities. It looks like economists have now gone a full 52.2%, a full flip into another rate hike of 25 basis points due in June. This is now the most hedged event. So be warned, it's unlikely markets can really dump heavily into the middle of June based on how many puts we know sit at 400 already and 390 on the SPY. So many. We'll take a look at that in subsequent videos. But really what it's telling us is higher for longer. GDP number came out for the US. It was strong. Unemployment, it looked strong. The US has some more work to do to get down to the 2% inflation target. And this is something that, of course, will end up impacting some stocks. So let's talk about yields and what it means for us as investors and whether we need to start thinking outside the box, not so much at AI, but other unloved areas of the market. Well, here is a breakout across yield curves. Obviously, the 10-year has been increasing in recent weeks after that huge sell-off it did in March. And when we tend to get these runs, we can start to look at some of the sectors that may potentially benefit from them. One of them is consumer staples, pretty unloved recently in the market, and certainly it had a great run on it. But as we come into the Q3 periods of the year, you'll find that staples often is a rotated in sector. Now, here's just an example of percentage of S&P 500 consumer staple stocks oversold, 14-day stochastic underneath 20. We're now in a point that we only usually find 4% of the time. That's not much. Annualized returns are very strong from these levels. Now, here's some stats just to show you other times it's happened. Obviously, we have a decent amount of data that goes back over the last kind of 50 years. And we can see here that in general, the returns are not too bad over the next 2 to 3 month periods. 6.6%, 75% of the time. Could be worse, of course, whenever you're looking at these. Here's another example of the S&P 500. After 60% of staple stocks are oversold, but 40%, of course, it's a little bit convoluted, this one, less than 40% of the S&P 500 stocks are oversold. We've had this stat a few times. Again, leads into okay returns over the next 6 months. But it's not just staples. It's also healthcare and also utilities. Another one here, percentage of S&P 500 utility stocks oversold on the 14-day is less than 20. Again, only 4% of the time do we get reads like this. And generally, they come with pretty good annualized returns. Here's an example of utilities after 80% of utility stocks are oversold. Well, you can see a little bit of a rough start here for utilities, but then it tends to go into some fairly nice stats again around 1 to 2 months later. So does this make sense with the current market conditions? Well, with so many of these sectors being undersold, we have to consider what is our expectation for the rest of the year. Do we expect exceptional returns? Well, generally technology stocks, if we're running a normal pre-election cycle, would theoretically run for a little bit longer. We'd actually run generally the June into July period, then a big bump would come. Somewhere around that next kind of quarter, we'd generally see weakness in the market. Now, if we believe that was true over this period of time, often people consider it the weakest months of the year. Basically, the next 2 to 6 months after, let's say, the middle of June tends to be a pretty bad time in the markets for the US. So if that's true, where could the big money hide? Well, of course, it could be hiding in defensives. And we've seen those two stats already in today's video, which can help us to come up with those conclusions. Here's some charts that I thought you might be interested in. First up, utilities versus the S&P 500. What do we think, guys? This one doesn't look very good, does it? Utilities has been underperforming for some time. Obviously, I was a bull in it in February into the beginning of April, and it ran pretty well actually against the generalized market. Obviously, technology did well, but if you compare it versus equal weight, you'll notice utilities did quite nicely. Now it's getting smashed. And I've brought this up a couple of times. We haven't seen the turn on it yet. But if we do continue to see weakness in utilities, weakness in staples, weakness in some of these markets, here's staples here, you can see going back into a demand zone, there could be a turn coming up soon that may interest people. And of course, it's outside of that box thinking where everyone's going for technology stocks and saying, well, I have to be in the technology stocks. Do you? Or can you find opportunity in other more boring or perceived boring markets? Of course, we are starting to get into some very good statistical periods. In terms of my thought process outside of AI, obviously AI has been running heavily. NVIDIA doing an amazing job recently at doing 26% in like a day. But really what's occurring here is also a revolution into everything to do with AI, everything to do with chip manufacturers and all those companies. What about cybersecurity? Is this an underloved sector? It was probably one of my favorite runs of 2020 into 2021. I loved cybersecurity. It has since become a very hated sector. And you can see here, if you've looked at this channel for a while, Invest Head and Shoulders, potentially we have here, of course, the opportunity of a bit of a trendline breakout. Is cybersecurity one of those ones where you go to it and you go to these stocks and you say, well, maybe these are a little bit cheap? You'll notice recently we've got Crowd breaking out, which is one of the companies that is certainly moving into the AI field. It's just an idea, but I thought I'd just show you that I think that whenever you're coming up with the idea that AI is now the future, doesn't that bring dangers of hacking with it? Well, I still think hacking is one of the most interesting components of the next decade. And securing against that is not only going to become really expensive, but the best companies may do well. What do you think in the comments down below? Let me know. Let's move over to the skew. Now the skew, no compression. So unlikely we get super heavy sells until we get compression on the skew. We started to see the signs. We started to see some selling in the S&P. Then boom, skew came back up. Now, if you know anything about the skew, it's basically a black swan indicator. It usually, the idea you use it is basically if it's increasing, something scary is about to happen. My general opinion is you can't really sell until you see a compression of the skew. We used this in April and August of last year to really predict some of the areas where markets were starting to weaken off. We need the skew to go down. It has not at this stage. US 3-month versus 10-year. If you're somebody believing that recession is coming, which totally don't blame you, I'm probably pretty sure that that is going to occur based on the bonds market, then you usually don't get a recession called until the 3-month or the 2-year is below the 10-year. We need inversion to go away. So until inversion goes away, generally speaking, it hasn't come just yet. We're seeing those strong GDP numbers, those strong labor market numbers come out of the US. It's still a very hot economy, even with the Federal Reserve doing its little dance. Speaking of the Federal Reserve, have they done enough? Well, I don't know what they're doing sometimes. No wonder the market can't come down very much. You can see here our central bank indicator continuously shows us that in the back door, the Fed is basically injecting into the market. They claim they're not. They obviously the taper list looks like this, but I tell you what, it's a bit frustrating if you're trying to be a bear in markets when the central bankers claim they're doing something and then they keep pumping in. The world central banks as a whole with the Fed, that's looking a lot more negative. And of course, these have been kind of like a fairly decent chart, most important chart to be following recently. So we're looking for that green line to go down. It hasn't been over the subsequent week. So it's hard to go with a big swing short at this stage until we see more information. Here's the same chart against the Qs. Obviously, the Qs are realistically totally overweight compared to the market overall. But at the same time, to predict the short here is going to be difficult. We've talked about the idea that selling Qs right now, selling the NASDAQ in comparison to selling the weaker markers, metals, energy, S&P, Russell, too hard. You have to see a turn. We don't have that yet. Speaking of weakness throughout markets, Dr. Copper is back. And of course, he is at the absolute pinnacle of demand. A breach of this level should expose 3.375. And that would probably bring a fairly decent sell-off on metals across the board, potentially energy as well, and some of those weaker sectors. Demand destruction is here, according to the metals market, but we're only seeing it in those sectors. So if you're still feeling short in the markets, watch copper, metals, energy. They're going to be the ones you're looking at. What about bonds market? Are we seeing a bit of a issue here? Well, certainly the stock market is completely disconnecting from the high yield junk bonds market. Now, when we've seen this, it tends to mean caution. We need to be cautious, and maybe there isn't that much gains to be had on the S&P around these levels. And I think when we look at the charts later on, you'll see what I mean by that. The high yield bonds, they're starting to drop off, but they weren't down much over the last 24 hours, only 0.07. If we keep seeing these drop and we keep seeing the stock market hovering, it's a good sign to stack with the skew and other confluence reasons to potentially say, well, maybe we're starting to see some issues. Debt ceiling is starting to put the effect on the bonds market. The move market is up. The VIX is up. Both statistics are really showing us that fear is starting to come back into the market, although it's not showing on price as AI drives everything. Dollar index also continues to strengthen. It's now into our profit target zone. If you were a dollar bull, congratulations, you really hit a great level. We'll talk about that later on. But that often shows us that if everyone's moving into defensives like the US dollar, then maybe the US market is a little overpriced at this stage. It's basically two of the three reasons so far that we've talked about. We don't have skew that, showing us we need to be cautious on these markets. Problem is, we also know that June is incredibly hedged. Let's jump over to the gambling options market because that's what's going on right now. And you can see that NVIDIA was the standout trade. We knew it would have the biggest amount of volume of the day, 3.48 times the relative 90-day average. Everyone was on the call side, 1.6 million units on the call side, 1+ million units on the put side. So still a decent amount of puts coming in. It doesn't mean that I think that it's going to crash straight away. We'll look at some of the biggest NVIDIA positions in just a few moments, but Tesla, another one that was finding a ton of calls. Underneath, though, its normal averages. Some standouts here were things like AMD. That was another one that ran heavily. Microsoft, another one that ran heavily. You can see the calls, mostly 0 DTEs or only a couple of days away. They have to be hedged off. It's causing those spikes across the board. And you can see, look at AMD. Look how much it did, 11.2%, 24.4%. Here's another one, TSM. Look at the calls, 6.12 times the average. I mean, the options market was getting wild with literally I would say not only big players, but also tons of retail traders jumping on these calls thinking this is the best squeeze I've ever seen. Let's go. It'll be okay for a little bit until it isn't, but you've got to be very, very careful here. And all of these unusually large day volumes, they can last for a little bit, but they will end poorly. And you just have to be able to spot the times. We'll be following the options market as closely as we can to see when the big players chuck some puts in, because when they do that, you're going to see some dumping and it will be wild. I would say, 10, 15%, only a couple of days. I would make that as almost a prediction that it will happen. You'll get a monster sell over a 2-day period. The question will be, when will we get it? Let's move over to the big trades on the SPY and Qs. We're still seeing a lot of puts on the Qs. So very, very tough for that to go down too much. Everybody seems to be loading up short date puts. Well, markets don't tend to fall when you got too many short date puts floating around. So Qs, still everybody wants to short them. I've said this a few times now. You do not want to short the Qs. You try to short the S&P, the IWM. In my opinion, metals and energy would be the weaker sectors in general over a multi-month period. It's very tough to short the Qs if you're on, everyone's trying to do it. It's just too tough. Gold is interesting as well. Notice the put call ratio here is only 0.2. So everybody's on the call side. Well, I've said for a while that we can't be on the call side at this point because of the demand destruction and that pushing through. And of course, you can see that with the gold side. We'll continue to follow that. But yeah, no wonder gold's getting hit so hard. Everybody's trying to buy it. Well, the people that are really making money have got those puts and they've got them out over quite a few months and they're making good coin at this point. Let's look at some of the big trades from the SPY and Q perspective. We have quite a lot of Friday expirations and 0 DTEs that came through. You can see here the Q calls, 340 Q call, big volume going through. The second big Q was 340 put, but it was a little bit smaller. Both for the same day, kind of equaling each other out to a degree. And then we have all these SPY calls and puts going through. And you can see it's pretty even across the board. Nothing stand out here in the options chain. Let's move over to the individual stocks. Again, some of the biggest plays for the day were no doubt NVIDIA, AMD, Tesla, and Apple. Tesla and Apple always in this chart, but I think AMD is not, and NVIDIA certainly isn't as well. Big volumes. How are they going? They're all on the call side, creating those squeezes into this Friday. I think after the Friday expiration, we might see some fireworks on some of these big positions. NVIDIA in particular, I'll be interested in watching next week. We will track that as much as possible across the board. Let's have a look at the sentiment survey. We now have a sentiment survey coming through. We can see here that people are voting a little bit more bullish, which is good. Of course, 24th of the 5th was when this sentiment survey was taken. You're wanting to see that thing back up into the 30s, 30 to 33% bulls. That would be a clear sign that everybody's gone on the bull train. If we see a skew compression, we continue to see high yield junk bonds, we continue to see some of our other indicators show weakness, then we see a technical switch, I think we know what to do, guys. But at this point, we have neutrality, we have bears, we have bulls. We certainly are going more in the case of bears being a winner soon, but we're not quite there, at least from a sentiment survey perspective. Let's have a look at rotation. Last 5 days, what's been the best? Semiconductors, no doubt. Technology's done very well in the last 24 hours. In particular, look at the ones down the bottom. Some of the ones we've been talking about potentially looking better soon. XLP, horror show, down 3.55%. Metals, horrible, down 3.6%. Gold, down 5%. These are certainly the sectors that you would expect to get hurt. And in particular, not so much the staples, but the metals and the gold ones. Yeah, I mean, that's absolutely demand destruction playing out. Here's the last 24 hours. I haven't seen a semiconductor 8% day in a very long time. That's a huge position and huge amounts of calls all over it. Again, gold was one of the underperformers. Utilities, healthcare, staples, all bad. So defensives not showing strength yet. If they do start to turn around, we could see a bit of a rotation from the street into those. As they go defensive, we need to start saying, whoa, alert, alarms everywhere. What's skew doing? What are these other things doing? Do we see sentiment surveys super bullish? If that happens, that's when the bears really want to strike on this market. At the moment, though, we're just not seeing enough signs. So we'll look more at the technicals than anything else. US 10-year, how's it going? Well, it's doing pretty good. It's going up quite strongly. This is because what we're seeing is higher for longer is the expectation of the Federal Reserve. So basically, we've got higher for longer on the yields, and that's what everybody's looking at. And US 2-year is trading accordingly, way up. We suspected this, but what we did think on this channel together is we all thought that, well, if we're going to get higher for longer, surely the market's going to crack it. And I think it probably should, because high yields, this isn't what everybody else was expecting. Remember, there was meant to be, 3 rate cuts this year. Now it's down to 1 rate cut expectation, and the Fed is saying no rate cuts till 2024 mid. So as we see those things start to change, you can be betting, or at least going with this idea that maybe this isn't priced in yet to these markets. And of course, that could come as a shock very, very soon. US dollar, super strong. Yields going up. Dollar, of course, becoming more desired. We're at critical resistance. I want to know what happens here. I think swing traders could be getting involved very, very soon. Fantastic target, though. We've hit a lot of key levels. I'm liking what we're seeing, and we'll be going down to the 15-minute chart very, very soon. You can see there's kind of like a trend line that's been following the last little bit. Continues to move higher, though. Dollar now at this resistance. So what it does here through the Friday session and the Monday session should open up some opportunity. Gold continued its weakness. You can see it's at 1935 lows. We've talked about this going weak. I still think it's possible to go to 1900, 1920. Could we bounce here? Yes, it is a demand zone. So you can see demand and previous resistance becoming support as well. So there's a lot of technical theories that would find buyers here. But in general, I think it's a very decent target if you were going for shorts. I still think that rallies should be met by sell demands. Look for the supply in here on the small time frames if you're a day trader. And it's a real target of 1920 should we get it there. This shows you, though, how fast things can change. Over here, many people hating. Gold, it's the next big thing. I'm just like, whoa. You got to really bring back those data, those stats. It's probably not. We've seen the sell-off since that point. And of course, we've got markets now falling down into where they are. But effectively, this is what you expect around this time of year. Gold and silver tend to underperform, and then they perform incredibly well later on. Take a look at silver, just getting absolutely smashed. It's like copper. It's a metal that's used in the economy. It's showing us that there is weakness being found in the economy, just not in AI stocks at this stage. Let's move over to natural gas. Interesting. It actually bounced off a level I thought it would. Then it failed to make a new high. That's upsetting if you were trying to go bullish. Right here is pretty much where you'd usually break even the trade if you were in it. But then it comes back down and knocks out that low. I think it knocked out this low as well. It probably means natural gas is going to the secondary target lower. So it's probably going down into this structural zone, which sits around $2.30, $2.25. I'm not a huge fan of trading natural gas, as I've said several times, but a lot of you have asked and requested it. So yeah, next up, I would say it probably goes a little bit lower here, guys. It probably comes into this 230. I'd like to see buyers there. That's a stronger buy zone. I'd like to see them come through with it. Oil sold off. Now, this is surprising. I thought it might go a little bit higher. So my thought process was oil coming back into here, this supply, this most traded zone, then finding sellers. I'm not sure how to feel about this. I mean, obviously, I am, medium-term bearish on oil, so I don't really mind. But from my perspective, I thought it might bounce a little bit more. We're back onto this trend line. As you can see, I've just kind of extrapolated that out. Looks like it's coming under weakness here. If it does breach through, back down to 66 for us on oil. And of course, it's just more of that confirmation of weakness in the economies around the world. Energy stocks were down on the session. They're kind of hovering around. Metals were down more. Metals been the better short than energy over the last couple of days, but you can see here what's happening. Is this a base? Is this just distribution before further selling? We'll find out. I do tend to find the start of June sometimes has strong energy pickups, so we've got to be a little bit careful against that. Let's move over to Tesla. How'd it do? Rallied up, then it sold off. Not quite hitting the 61.8. That would have been a good day trade short. It didn't do it. Two long leg dojis. Very unhelpful. It doesn't really help us too much. I would suspect there's weakness here on Tesla at these prices. We managed to get up to these highly traded zones, the 61.8 of the whole high to low swing. I haven't lost faith in the 145 short eventually coming through. It just takes time. And we got the rally that we suspected. So the rally happened. The sell is beginning. We need to now see whether we can get a new leg down. And I think at this point, I'd probably be more bearish than bullish on Tesla. And that's just the way I'd look at it. Let's move over to Apple. It's very stuck. So I've said that I think big funds are probably going towards descaling a position here. AI hasn't even been enough to bring Apple up. I often call it the canary in the coal mine because it's so traded by retail traders. And look, we're getting some nice structure here. We get an island reversal at the top. The market drops off. This is still possibly a massive island reversal on the higher time frames, such as the daily. So if we go back down and then we gap underneath, I think it could be on for bears. So, we're watching Apple very closely. It held the low. It bounced back up. It's come and tried to fill that gap. Nice. Now we see whether it bounces to go the other gap and then come down, or it just starts to kind of flow off as we see some weakness. This is also a big trend line. So we have a lot of confluence coming up on Apple very, very soon. Good chart to have on, certainly watching it closely. Google, not much to state, obviously did very well off the NVIDIA news. Wasn't anywhere near as good as AMD. And speaking of AMD, I just want to bring that on the chart so we can look at it. Take a look at there it is. Look at it running out. It's probably got a little bit more in it. You would have to suspect into these highs. We've had this 122, 125 level for a while on AMD. So I still think that's possible as it ramps into the whole NVIDIA concept. Do I think it's worth it? I don't, but hey, well, this is the trend and it's currently going that way. NVIDIA, let's talk about it. Weekly, absolutely outlandish weekly. We've got one more trade day. I'd like to see it hold up and actually squeeze a little bit more if possible. Then we get rid of all these options expirations and potentially bring in a big sell. Now we're looking here ideally for something like this to occur. Boom. I want to see absolute obliteration, 10, 15% down very quickly, 1-2 days. Then I want to see a rally. Then I believe we've seen what we need to see. But at this point, the trend is still up. I can't see a reason why I'd short it. You might say, Tom, there's every reason under the sun. What the hell are you talking about, man? It's up 26% in a day. Yeah, but we've seen this play out before. Do you remember Moderna? Do you remember NVIDIA last time? This is no chump change. This is a lot of move. That's 65% in only a couple of weeks. And this does look like that bubbly kind of stuff. But if people start calling it a bubble, usually there's more to come. So it could still just be the beginning of all of this. And I know that seems unrealistic, but yeah, bubbles get big, things get wild, and we have to be very, very cautious. Disney's continued its way down. Now, I think Disney's going for 84. I still think Disney presents an interesting opportunity for the investor and possibly the trader moving forward. We are looking at it. I just know it has horrible pre-election years, and I'm watching it and seeing how it trades. So at the moment, it's still weak. We haven't seen a turn, but a few people asked about it. KRE, I'm not interested in this at the moment. It hit our first target. Fantastic. I want to see what it does next. I would suspect it comes down and starts to weaken. What about the DAX? All our European followers. If you got that short, congrats to you. Very nice. DAX actually hit a multi-year high, then shorted off. I'm watching the weekly here to see what happens. If we do end up getting a closure underneath these wicks, let's say Friday sells hard, then we're pretty sure that all rallies should be met by sell demand. That would be a huge rejection here on the DAX. Does look weak, and it shows you the difference of the markets right now. Australian market doesn't look good at all. I still think we're going down to 7,000, 7,100 easily. I've been very negative on it here. I've been very negative on it here. It's all about copper, and at the moment we might get a little recovery, but the daily close is pretty bad. When we go over to the weekly close, obviously a nice closure zone underneath the wicks generally doesn't bode well for upcoming weeks. So I think that the Australian market still looks a little weak here, and that's just what we're seeing on the charts, and we're continuing to follow that story of course, copper, metals, etc. You could also make a case that this 61.8, which I've got here pulled, could be a very important point, which is just underneath 7,100. So it's not necessarily a huge amount more sell-off before some rallies, but I still think there's more to go on this market. IWM looks terrible. It's back to the most traded zone, so buyers may commit themselves here. People will have been sucked into this buyout. We know that we weren't doing that here because, of course, we wanted to see closures before doing anything. So I think some people are trapped in buys here and getting squeezed backwards. This market is trading at what I call equilibrium. So it's trading at fair value for it at this stage. If we get a new low break, you know what I say. Russell is possibly the best indication we have on the US market at the moment as an index that weakness is there. But there is another one, the Dow. Take a look at the Dow. It's horrible. 1, 2, 3, 4, 5, 6. That's a lot. While everything else is going up, the Dow is getting obliterated. And it's not just the Dow, it's the transportation average. Now, it didn't end up doing a 5 count, but if it did, 1, 2, 3, 4, if it did a 5 count, that would have been a double signal to a very rare circumstance that we have very barely seen. Only 2011 and 2020. So the Dow is showing us concerns of the debt ceiling. The Dow is showing us concerns of the AAA rating plus for America's credit, I guess, getting degraded again like it did in 2011. There are concerns here, and the Dow is telling a very different story to the rest of the market. And when I say the rest of the market, it's just AI and semiconductors. So if you're in AI and semiconductors, good times. If you're not, well, again, there are shorts here. They're just different sections of the market. They're not necessarily the main ones. So here's the Qs, massive gap up. You could literally call this an island reversal. That's usually too much for me to kind of handle in terms of island reversals. I like an island reversal. It starts like here, so you can ramp it. This one was just getting ballistic as soon as you could kind of tell it was going to go like that. Do we have a high? Well, the problem is this structure here. I don't know whether the NASDAQ will go here first before finding sells. And that's the problem. We're in the middle of nowhere land, la land almost. If we actually get a fixed range indicator here and have a look, you'll see that we're about to touch that POC of the range. So although that's not a super indicator, it sits on the expected weekly options high. It is around that zone. I think that we've got to be cautious. Here's the US 100. We hit a massive TD. We sold off, which was the exhaustion. And then now we've started a new sequence. So we're no longer on the weekly we are. On the weekly, we're on a monster sequence. But on the daily, we're on a new sequence. On the smaller timeframes, we're on a new sequence. So we still haven't actually got into the next area. We're in question mark land, and we're not sure whether it's going to short yet. We don't have enough reasons. Even the short from yesterday, if you had gone at it, let's say you'd had a go at this one here, we never got the extra conversion, which was to see something like this, and then you could short it for sure. We obviously got wiped off the highs if you were going to do that. It just wasn't really happening. SPX, is this another island reversal to continuous higher? Well, time will tell. Not sure about that. We've talked about the BC, the UT, and the UTAD, and of course, Wyckoff's concepts around this. This is the kind of thing we're looking for. So the rally here, we're hoping is met by fairly swift sells, and then we start to consolidate somewhere around 40, 60, 40, 50. If we do that and we consolidate for a little bit, well, I think we've seen this play out before. So, of course, we'll be paying a lot of attention to that in subsequent days. Let's have a look at the Bollinger. We are sitting right in the middle, which is the 20 moving average. So we're basically at mean reversion. Very little information we can get from that one. We'll move over here to a chart that looks probably insane when you first see it. But don't worry, we'll dissect it now. What we're trying to do is we're kind of trapping in a couple of zones. We know there's buyers here and they bought in. We know that there's probably some sellers up in these 4170 to 4190 zone, and we're kind of trapped within those two levels. So let's have a look at the structure here to start off with. So the first structure is we busted through this supply. There's the high, and we obviously have supply, and we didn't close a body on most timeframes. In fact, most of this bust was all wick rejected, which is a little harder to understand. So we rally the area you expect. We find the rallies. Then now, over the next 24 hours, if we pull back down, where do I think the buyers are? Somewhere around 41.25 to 41.30. If the buyers do commit there and then start to move it forward, 41.80, 41.90 for the intraday would be very interesting. If we get a sell that closes below 41.25 though, I think we're going to break 4100. And when we break 4100, we all know the next zone is 40.60, 40.50. So yeah, I have a suspicion this Friday could be very good closure to understand the next move for the S&P. So yeah, again, 41.25, 41.30, interesting buy area to see whether the buyers like it. If they do, they may push it to 41.70, 41.90. I think 41.86, this supply in here is interesting. And then, of course, if we get a closure below 41, let's say 15 or 10 or something, I think we'll actually break 4100 and then we'll go towards 40.60. So that'll bring those bears out for the next little period. We'll move over to Bitcoin. It still looks weak with that daily close. The rallies have been mostly lackluster. This is the supply you don't want busted if you're a bear. So if you're a bear, yeah, it's allowed to come in here, but you don't want it to go higher than that. So you want to see selling here down to 24K. And if we do get the sell to 24K, it probably means the stock market is going to come at least temporarily for a sell. Big news is core PCE price index. That's at 8:30 a.m. New York time on Friday. And of course, as always, if you've enjoyed this video, please remember to subscribe. A lot of content through here. Obviously, takes a little while to complete it. If you do enjoy it, subscribe, smash that like button, guys. Follow us on some of our other socials. And of course, if you're interested in a couple of free trading cheat sheets, you can get them as well. Thanks so much for watching. We'll see you after the Friday close. And I'm excited for what we see on NVIDIA. I really think it's going to be a great learning curve for a lot of people out there on what happens during these markets. For some people, it may be their first huge move, huge bull run, and then potentially big bust off, blow off. So we're not predicting it yet. We're just looking for the signs. And of course, I think some big players would have descaled a little bit over the last 24 hours. I know I'd trim if I hit $300-400 a stock. It's pretty good. Bye for now.